Did you know that over 90% of investors make the same common mistakes when it comes to managing their money? These mistakes can cost you years of potential growth and missed opportunities. Have you ever wondered how some people consistently build wealth while others struggle to make progress despite their best efforts? In today's video, we're going to unlock the key strategies from Terry Smith's Investing for Growth to help you make smarter financial decisions. We'll break down essential principles that will guide you towards investing in real business value, minimizing risks, and focusing on long-term success. By the end of this video, you'll have practical, actionable advice to transform your approach to investing, allowing you to build wealth the right way and avoid costly mistakes. Don't miss out on the chance to take control of your financial future. Number 1. Invest in high-quality businesses. Terry Smith emphasizes the importance of investing in high-quality businesses, which are companies that demonstrate strong competitive advantages, consistent growth, and high returns on capital. A high-quality business typically operates in a market with barriers to entry, has a clear and effective business model, and can generate significant returns over time. These companies are less likely to be affected by short-term market fluctuations and are better equipped to sustain growth during economic downturns. Investing in such businesses means you are putting your money in companies with long-term potential and solid fundamentals. To evaluate a high-quality business, look for companies with proven track records of profitability, a robust brand, and strong management. These businesses often have a competitive edge, whether through innovation, customer loyalty, or operational efficiency, which makes them more resilient to challenges. A good example is investing in companies like Apple or Microsoft, which have dominant positions in their industries and generate high returns on their capital. Practical example. Let's say you're considering investing in a tech company. Rather than choosing a startup with an unproven track record, you might opt for a company like Apple, which has a solid market presence, a loyal customer base, and a history of continuous growth. Apple's ability to consistently innovate with products like the iPhone or the MacBook is a sign of its strong competitive advantage in the technology sector. Practical tip. Research the company's financials. Look at metrics like return on equity, ROE, return on assets, ROA, and profit margins. High-quality companies tend to have consistently strong financial metrics over time. Assess the competitive advantage. Ask yourself, does the company have something unique that allows it to outperform competitors, like a dominant market position, proprietary technology, or strong brand recognition? Long-term focus. Instead of focusing on short-term fluctuations, focus on whether the business can continue to perform well in the long run. High-quality businesses often recover from downturns and continue to thrive over time. By consistently investing in high-quality businesses, you position yourself for long-term growth and minimize the risk of poor investment choices driven by market hype or short-term trends. Number 2. The importance of patience. In Investing for Growth, Terry Smith accentuates that investing isn't a shortcut to wealth, but rather a long-term commitment. One of the most critical qualities for successful investing is patience. When you invest in high-quality companies or assets, the returns often take time to materialize, and you need to resist the temptation to check stock prices daily or react to short-term market movements. Instead, you should focus on the company's fundamentals and allow your investments to grow steadily over the years. Investing requires you to stay calm during market fluctuations and avoid impulsive decisions based on temporary dips or rallies. Smith points out that compounding returns, which are key to growing wealth over time, require you to leave your investments undisturbed. The longer you stay invested, the more your wealth can grow, thanks to the compounding effect. So, rather than making emotional decisions based on fear or excitement, successful investors remain focused on their long-term strategy. Practical example. Let's say you invested in a solid company like Amazon 10 years ago, and over the years, its stock price experienced ups and downs. If you had sold your shares during one of the dips due to panic or impatience, you would have missed out on the significant growth that happened in the following years. However, if you had remained patient and held on to your shares, your investment would have grown substantially. Practical tip. Set a long-term investment goal. When investing, define a long-term objective, such as I want to hold these stocks for 10 years, and stick to it. This helps you avoid reacting to daily market noise. Use dollar-cost averaging. To prevent getting distracted by short-term market movements, invest a fixed amount regularly, e.g. monthly, in your chosen assets, regardless of the market's fluctuations. This helps you stay focused on the long term, making it easier to ignore the noise and stick to your plan. Remind yourself of the big picture. Whenever you're tempted to make an impulsive decision based on shorter market movements, take a step back and remind yourself why you chose those investments in the first place, because they are strong businesses with potential for long-term growth. By practicing patience and sticking to a long-term strategy, you allow your investments to grow as intended and avoid the emotional pitfalls that often lead to poor decision-making in investing. Number 3, avoid trying to time the market. One of the key insights Terry Smith shares in Investing for Growth is the danger of trying to time the market. Many investors attempt to predict the right moments to buy or sell based on short-term trends or forecasts about the economy. However, trying to time the market is extremely difficult and often leads to poor results. Financial markets are influenced by numerous factors, many of which are unpredictable. So attempting to time market moves can result in missed opportunities or selling investments too soon during temporary downturns. Smith argues that instead of focusing on market timing, investors should focus on buying high-quality businesses and holding them for the long term. When you invest in solid companies with good growth prospects, your returns are more likely to be positive over time, regardless of short-term market movements. Short-term fluctuations should not be the deciding factor in your investment strategy. Rather, it's the long-term growth potential of the businesses you invest in that matters most. Practical example. Imagine you're considering investing in the stock market and see that the market has just experienced a small dip. You might feel tempted to wait for the perfect moment to invest when prices are lower. However, if you keep waiting for the right time, you may miss out on gains. Historically, the market tends to rise over the long term, even though it experiences dips along the way. A long-term investor who buys and holds quality assets like Apple or Google doesn't worry about the daily fluctuations. They benefit from the growth that accumulates over time. Practical tip: invest consistently. Instead of trying to time the market, develop a habit of consistent investing. Consider using dollar-cost averaging (DCA), where you invest a fixed amount of money at regular intervals, monthly or quarterly, regardless of market conditions. This strategy ensures you're not overly influenced by short-term market movements and helps you accumulate assets at a steady pace over time. Focus on long-term goals. Set clear long-term financial goals and align your investments with these goals. Trust that by focusing on businesses with strong fundamentals and staying invested over the long term, you will achieve better results than trying to chase short-term market trends. By avoiding the temptation to time the market and focusing on investing in quality assets for the long term, you set yourself up for steadier, more predictable financial growth. Number 4, focus on growth, not speculation. Terry Smith emphasizes the importance of growth investing for growth. Unlike speculative investing, which often involves betting on short-term price movements or trying to capitalize on market trends that are hard to predict, growth investing is about finding businesses that have the potential to grow significantly over time. These companies usually operate in sectors with long-term demand, have sustainable business models, and can increase their profits consistently. When you focus on growth, you prioritize investing in companies with a clear path to expanding their market share, improving their products or services, and generating solid, predictable profits over the long term. Speculation, on the other hand, tends to focus more on price movements, and this often leads to more risk and volatility. By investing in growth, you're not just looking for an immediate spike in prices, but rather seeking to align your investments with companies that have strong fundamentals and sustainable growth trajectories. Practical example: consider investing in a company like Tesla. While the stock price of Tesla may experience short-term volatility, it can go up or down based on news or market sentiment. The company's long-term potential comes from its leadership in electric vehicles and its innovative energy solutions. If you are focused on growth, you would invest in Tesla because you believe in its future prospects for growth in the clean energy and automotive sectors, rather than simply trying to time when the stock price is low and selling it when it rises. Practical tip: look beyond short-term gains. When considering an investment, ask yourself, does this company have a strong growth strategy for the next 5 to 10 years? For example, consider factors like innovation, leadership in its industry, and long-term competitive advantages. If the answer is yes, then you may have found a growth opportunity. Avoid chasing hot stocks based on hype. Many investors are tempted by stocks that are trending or have been heavily promoted in the media, such as meme stocks or speculative IPOs. Instead, focus on companies that have a proven business model and the potential to grow steadily over time. This will help you avoid speculative traps and make more informed, sustainable investment decisions. By focusing on growth rather than speculation, you are more likely to build wealth steadily and confidently, minimizing risk and avoiding the volatility that comes with trying to chase short-term trends. Number 5, avoid overpaying for investments. In Investing for Growth, Terry Smith stresses the importance of valuations in the investment process. While it's tempting to buy into a popular stock or company because of its reputation or recent performance, paying too much for an investment can significantly reduce your future returns. Overpaying means you're essentially paying a premium that may never be justified by the company's future growth. The key to successful investing is finding quality companies at reasonable prices, ensuring that you're not overpaying for their potential. Smith explains that the price you pay for an investment is crucial because it directly impacts your returns. If you buy a business that is overvalued, even if the company continues to grow, your returns might be less than expected because you started with an inflated price. A smart investor should be aware of metrics like the price-to-earnings, P/E ratio, price-to-book ratio, and other valuation tools to determine whether an investment is priced fairly. Practical example: suppose you're interested in investing in a popular company, say Netflix. While Netflix is a leader in its industry, if you buy it at a time when its stock price is extremely high, perhaps after a strong earnings report or a media buzz, you may be overpaying. Even if the company continues to grow, your returns will be lower because you've paid a premium for the stock. A more prudent approach would be to wait for the stock to stabilize at a more reasonable price, ensuring you're not overpaying for future growth. Practical tip: evaluate valuation ratios. Before investing, check the company's valuation. A P/E ratio that's too high could indicate the stock is overpriced. Compare it with similar companies in the same industry to get a sense of whether you're paying a fair price. Be patient with price swings. If you find a company you believe in, but the price feels too high, be patient. You don't need to buy immediately. Markets often go through ups and downs, and prices may eventually become more reasonable, offering a better buying opportunity. Avoid FOMO, fear of missing out. Just because a stock is trending or other investors are excited doesn't mean it's a good buy. Focus on finding investments with a fair price relative to their long-term potential, rather than getting caught up in the excitement. By avoiding overpaying for investments, you set yourself up for better returns and minimize the risk of buying into overpriced stocks that could underperform in the future. Number 6, focus on the business, not the stock price. Terry Smith stresses in Investing for Growth that investors should focus on the business itself, rather than obsessing over short-term stock price fluctuations. The value of a company is based on its fundamentals, its ability to generate revenue, sustain profits, and grow over time. However, stock prices can be volatile in the short term due to factors like market sentiment, news, or external events, and this volatility can cause investors to make irrational decisions. Instead, Smith encourages you to concentrate on the company's long-term potential and its underlying business operations, rather than its day-to-day stock price movements. When you focus on the business, you are paying attention to things like the company's competitive advantages, its market position, and how it's managed. You will also have a deeper understanding of its growth strategy and how well it can weather economic cycles. Over time, businesses that are well managed and positioned in growing markets are likely to see their stock prices rise in a sustainable manner. It's critical to remember that the stock price is often a reflection of market perception, not always the true value of the business itself. Practical example. Consider an investor who is interested in a company like Apple. Over short periods, Apple's stock price might fluctuate based on investor sentiment or macroeconomic events. However, if you focus on Apple's core business, its innovative product line, strong brand loyalty, and consistent earnings growth, you will see the real value of the company, independent of its stock price. If you've done your research and believe in the company's future growth, the stock price dips or short-term volatility should not influence your decision to buy or sell. Practical tip: evaluate business fundamentals. When considering an investment, look beyond stock price movements. Ask questions like, is the company profitable? Does it have a competitive advantage? Does it have a clear growth strategy? If the answers are yes, then the business is likely on a solid foundation, and its stock price will eventually reflect that over time. Ignore the noise. News and rumors can cause stock prices to move up or down rapidly, but these moves often don't reflect the underlying value of the company. Focus on the company's ability to grow, manage its business, and adapt to market conditions, rather than reacting to every price change. By focusing on the business and its long-term potential, rather than worrying about short-term stock price fluctuations, you make better-informed decisions and avoid being swayed by temporary market emotions. This approach helps build a more stable, thoughtful investment strategy. Number 7. Stick to your investment strategy. In Investing for Growth, Terry Smith emphasizes the importance of sticking to a well-thought-out investment strategy. Successful investing requires consistency and discipline. Many investors are tempted to change their approach based on short-term market movements, media noise, or emotional reactions. However, shifting strategies based on fleeting market conditions can lead to poor investment decisions and missed opportunities. By sticking to your plan, especially during times of market volatility, you can avoid making impulsive decisions that could negatively impact your long-term financial goals. Smith argues that having a clear investment strategy, which could include guidelines for asset allocation, diversification, and choosing investments with strong fundamentals, ensures that your decisions are driven by logic and long-term thinking, rather than emotions or market hype. While it's important to adjust your strategy when there are fundamental changes in your goals or circumstances, frequent changes based on market noise can undermine the value of a disciplined approach. Practical example. Imagine you've decided to invest in a mix of high-quality growth stocks based on a solid research strategy. During a market downturn, you might feel anxious and tempted to sell off your investments to avoid further losses. However, sticking to your investment strategy means resisting the temptation to panic and sell during a dip. If your strategy was based on long-term growth, selling prematurely would likely undermine your plan. The key is to stay the course and remain focused on your long-term financial goals, rather than reacting to short-term market fluctuations. Practical tip: review and adjust, don't overhaul. While sticking to your investment strategy is important, that doesn't mean it's set in stone. It's wise to periodically review your strategy to ensure it aligns with your evolving goals, market conditions, and personal financial situation. However, avoid overreacting to market movements by making drastic changes to your investment approach. Set realistic expectations. When creating your investment strategy, set realistic expectations about returns and risks. Understand that markets will experience ups and downs, but if your strategy is focused on solid, long-term growth, sticking to it will pay off in the end. By sticking to your investment strategy, you minimize the influence of short-term volatility on your decisions. This consistency allows you to stay focused on your long-term financial goals, ultimately leading to more stable, sustainable growth over time. Number 8. Be patient and avoid emotional reactions. Terry Smith highlights the importance of patience in investing. In Investing for Growth, He explains that emotional reactions to short-term market movements often lead to impulsive decisions that hurt long-term financial success. Many investors, especially those new to the market, are prone to making decisions based on fear during downturns or greed during market rallies. These emotional reactions, while natural, can cloud judgment and cause you to make moves that are inconsistent with your long-term goals. The key is to maintain emotional discipline and trust in the strategy you've created. The market will inevitably experience fluctuations, but these should not dictate your investment decisions. Smith advocates for a mindset that treats investing as a long-term journey. By avoiding knee-jerk reactions and being patient, you allow your investments to grow and compound over time, which is how wealth is built. Patience also means resisting the temptation to check your portfolio every day or panic during downturns, as this can lead to rash decisions that could harm your overall returns. Practical example. Imagine that you've invested in a company like Amazon because you believe in its long-term growth potential. A market correction occurs, and Amazon stock drops by 10%. Initially, it might be tempting to sell off your shares in a panic. However, if you can stay patient and remember that market dips are normal and often short-lived, you're more likely to benefit from Amazon's continued growth over the years. Instead of reacting emotionally, you allow the investment to work toward your long-term goals. Practical tip: automate and set it and forget it. One way to avoid emotional reactions is by setting up automatic investments, such as dollar-cost averaging. By automating your investments, you're less likely to act on short-term market fluctuations. Set your contributions to go into your investment portfolio regularly, regardless of market conditions, and avoid checking your portfolio too often to reduce the temptation to make emotional decisions. Have a long-term view. When you make an investment, remind yourself that it's for the long haul. Stay focused on the company's growth potential and your financial objectives. Even during market downturns, remember that the goal is to weather the volatility and let your investment grow over time. Being patient and avoiding emotional reactions can be one of the most valuable tools for any investor. By staying calm, sticking to your plan, and letting time work in your favor, you allow your investments to ride out the inevitable ups and downs of the market. This approach leads to more stable, consistent growth over the long term. Number 9. Ignore short-term market fluctuations. Terry Smith stresses the importance of ignoring short-term market fluctuations. Many investors become overly focused on day-to-day or week-to-week changes in the market, allowing these fluctuations to dictate their investment behavior. However, Smith argues that these short-term movements are often noise and should not distract from a long-term investment strategy. The market is volatile, and short-term changes are inevitable, but they don't necessarily reflect the true value of a company or investment. What matters more is the long-term fundamentals and the ability of a business to grow over time. Smith encourages investors to take a broader view, focusing on the long-term prospects of their investments. By doing so, you avoid making decisions based on fear during downturns or greed during rallies. If you constantly react to market movements, you risk buying at the top or selling at the bottom, which could harm your overall returns. Successful investors recognize that volatility is a natural part of the market, and they stay focused on their strategy and the long-term growth potential of their investments. Practical example. Let's say you own shares in a company like Tesla. Over the course of a week, Tesla's stock fluctuates by 5%, with large price swings driven by market sentiment or news stories. Rather than reacting emotionally to the price changes and potentially selling when the stock dips, stick to your strategy. If you believe in Tesla's long-term growth potential based on solid business fundamentals, then these fluctuations shouldn't affect your decision to hold or buy more shares. Practical tip: limit portfolio checking. To avoid getting caught up in short-term market fluctuations, consider limiting how often you check your investment portfolio. By checking less frequently, you're less likely to react to temporary market dips or rallies. Instead, focus on the long-term strategy you've put in place and trust that your investments will grow over time. Set long-term goals. When investing, set clear long-term financial goals. Knowing your target, whether it's saving for retirement, a big purchase, or funding a future project, will help you keep your focus on what truly matters. Short-term fluctuations won't derail your progress if you stay focused on these bigger objectives. By ignoring short-term market fluctuations and focusing on the long-term fundamentals of your investments, you protect yourself from making emotional and impulsive decisions. This approach allows you to ride out the inevitable ups and downs of the market and make better investment choices over time. Number 10. Focus on quality over quantity. In Investing for Growth, Terry Smith emphasizes the importance of focusing on quality over quantity when selecting investments. Rather than trying to diversify your portfolio with a large number of investments in hopes of spreading risk, Smith advocates for concentrating on fewer, high-quality companies with strong growth potential. This approach allows investors to allocate their resources to companies that have a proven track record, solid financials, and long-term prospects, rather than simply buying more stocks to increase the number of holdings. By focusing on quality, you avoid spreading yourself too thin across too many mediocre or low-performing companies. Quality investments are those that are not only financially sound, but also have a competitive edge, strong management, and a clear path to sustainable growth. These companies are more likely to provide consistent returns over the long term, while poor quality companies can underperform and even bring down your overall portfolio performance. Practical example. Let's consider an investor who has the option of choosing between two stocks, Company A and Company B. Company A is a well-established business with a strong market position, excellent management, and consistent revenue growth, while Company B is a smaller, less proven company with volatile earnings. Instead of diversifying and buying stocks in both companies, focusing on the quality of Company A might be the better choice, as it has a stronger foundation and growth potential in the long run. By sticking with fewer but better companies, you're likely to see more stable returns and less risk. Practical tip: invest in core businesses. Instead of over-diversifying, focus on investing in core businesses that are high quality and align with your goals. For example, rather than owning a large number of tech stocks, focus on one or two companies that have a competitive advantage and are leaders in their respective industries, such as Apple or Microsoft. Research and assess quality. Take the time to research the companies you're interested in. Look at their financial health, growth prospects, and competitive advantages. Invest in companies with strong management teams and proven business models, rather than companies that are overly speculative or dependent on market trends. By focusing on quality investments rather than quantity, you reduce the complexity of managing a portfolio and improve the potential for better long-term returns. It's about selecting companies that are likely to grow and withstand economic cycles, providing you with stability and higher performance over time. Number 11. Keep costs low. Terry Smith underscores the importance of keeping costs low when managing your investments. High fees, whether in the form of management fees, transaction fees, or other hidden costs, can significantly erode your returns over time. Even if an investment performs well, a large portion of those gains could be lost to fees if they aren't managed properly. Smith emphasizes that, when it comes to investing, it's crucial to minimize unnecessary expenses to maximize the growth potential of your portfolio. This is especially true for long-term investments, where the compounded effect of high fees can add up substantially. The key to minimizing costs is choosing low-cost investment products like index funds or exchange-traded funds, ETFs, that track the broader market. These funds tend to have lower management fees compared to actively managed funds, which often come with higher costs due to the involvement of fund managers making frequent trades. By focusing on low-cost options, you allow your investments to grow more effectively, without unnecessary costs eating into your returns. Practical example. Let's say you're choosing between two investment funds. Fund A is an actively managed mutual fund with a high management fee of 1.5%, while Fund B is a low-cost index fund that tracks the overall market with a management fee of just 0.05%. While Fund A might have higher potential for short-term returns due to the active management, the higher fees could significantly reduce your long-term gains, especially if the fund doesn't consistently outperform the market. On the other hand, Fund B, despite its lower management fee, will likely offer more consistent long-term returns because it tracks the broader market and is less expensive to manage. Practical tip: choose low-cost investment options instead of opting for high-fee mutual funds or actively managed portfolios. Look for low-cost index funds or ETFs. These funds offer broad market exposure at a fraction of the cost and tend to outperform most actively managed funds in the long run. For instance, investing in an S&P 500 index fund can give you exposure to the top 500 companies in the U.S. with minimal fees. Be aware of hidden fees. Always be on the lookout for hidden fees in financial products. Some financial products may have costs that aren't immediately obvious, such as trading fees, annual maintenance fees, or performance-based fees. Make sure to carefully review the fee structure of any investment product before committing to it. By keeping costs low and choosing efficient, low-fee investment options, you can ensure that more of your money is working for you, maximizing your long-term returns. Over time, the money you save on fees can compound, providing a significant advantage in achieving your financial goals. Number 12. Focus on real business value. Terry Smith talks about the importance of focusing on real business value when making investment decisions. He argues that the true measure of an investment's worth is not the market sentiment or short-term speculative trends, but rather the actual strength and performance of the business behind it. A business that is genuinely adding value to the economy, with solid products, services, and long-term growth potential, is a far more reliable investment than one driven purely by hype or short-term trends. By investing in companies that are focused on creating real value, whether through innovation, efficiency, or customer satisfaction, you're more likely to see sustained growth over time. Speculative investments, on the other hand, may be tempting because they promise quick gains, but they often lack the underlying fundamentals to back them up. These types of investments are often influenced by emotions, trends, or market hype rather than the actual value the business is generating. Focusing on businesses that are genuinely contributing to economic growth and are well-managed ensures that your investments are more likely to be stable, profitable, and sustainable in the long run. Practical example: imagine two companies, Company A and Company B. Company A is a well-established company with a proven business model, consistent profits, and a clear path to long-term growth. It is innovating in its industry and has a solid customer base. Company B, on the other hand, is a tech startup that is getting a lot of media attention because of a new product that's generating a lot of hype, but the company has little history of profitability and its long-term prospects are uncertain. Even though Company B might look like an exciting opportunity due to the media buzz, it is more speculative and less stable than Company A, which is grounded in real business value. By focusing on Company A, whose performance is driven by strong fundamentals, an investor can avoid the risks of short-term speculation and make a more reliable investment. Practical tip: research the fundamentals. Before investing, dive deep into the financials and operations of the business. Look at factors like revenue growth, profit margins, management quality, and customer satisfaction. If a company is creating long-term value through innovation, solid products, and efficient operations, it's likely a better investment than one simply riding a wave of media attention or temporary trends. And again, avoid FOMO. Fear of missing out. The media and social platforms can often create a sense of urgency or excitement around a stock that might not be based on actual business performance. Resist the temptation to jump into these investments purely based on market excitement. Instead, base your decisions on the company's real ability to generate value and create long-term wealth. By focusing on businesses that are creating real, sustainable value, rather than those driven by hype or speculation, you will likely see more consistent and reliable returns over time. This strategy helps you avoid the pitfalls of short-term market fluctuations and ensures that your investments are backed by solid, tangible growth.